Hello, good evening, and welcome. The Economist magazine is widely regarded as the world's most prestigious publication, and it's very much the go-to place for international investors. It was published for the first time in 1843. For context, that is only 15 years after Shaka was assassinated by his half-brothers, and well before the discovery of gold and diamonds turned South Africa from a backwater into a global financial hub. Well, The Economist has gone bullish on South Africa. Here's the story. South Africa's economy has long been defined by big holes. For a century, those were the diamond and gold mines that built the continent's most industrialized nation. But, as a new analysis from The Economist points out, the only big hole the country has been known for recently is the one its economy has fallen into. It's a stark picture. Our national wealth per person, or what economists call GDP per capita, is lower today than it was 20 years ago. South Africa has slid from the 27th to the 39th largest economy in the world, overtaken by the likes of Bangladesh and Thailand. But The Economist, which is the world's most prestigious business publication, reports that a swelling group of optimists believe the narrative is now shifting. Leading this charge is Adi Enthoven, boss of the investment firm Yellowwoods and scion of the family that owns Nando's and Hollard. Enthoven, a strong voice in big businesses' body Business Leadership South Africa, argues that after a decade of decline, South Africa has turned the corner. So what's the evidence? The Economist tells readers around the world that there's been a quiet but critical shift away from state-run monopolies Eskom and Transnet, and that is making the difference. First, electricity. We've gone from 284 days of blackouts in 2023 to just 8 last year. This isn't just luck. It's the result of better management at Eskom and a massive boom in private solar. But the structural changes go deeper. For a century, Eskom has held a monopoly on power. Now, the generation of electricity is open to the private sector, with developers eyeing an astonishing 220 gigawatts of renewable projects. That's over 4 times Eskom's current capacity. The same medicine is being applied to logistics. Transnet, long a bottleneck for exports, has awarded a 25-year concession to the Philippines-headquartered multinational ICTSI to run the Durban Port terminal. Critically, the Filipinos balked at taking over existing staff, and yet they still won the contract, which was awarded in mid-2023. It's been a little delayed, but that was through an unsuccessful court challenge by the Danish shipping and logistics company Maersk, something that shows our courts also work well. As importantly, on the Transnet side, private rail operators are finally gaining access to freight routes, and that could turbocharge our exports. The macro numbers are following suit. The Economist notes that in 2025, South Africa recorded consecutive primary budget surpluses, that is, the state spending excluding interest payments, for the first time in 15 years. And recently, S&P upgraded the country's sovereign debt outlook, again, a first in ages. However, The Economist warns South Africans not to pop the champagne just yet. Despite these reforms, the IMF does not expect growth to exceed 2% over the next 5 years. That's far too slow to make a real dent in unemployment, which remains at a staggering 32%. The Economist's report also cites a chilling concern from business leaders: the rise of what they call a mafia state. One investment fund head worries about the potential Mexification of South Africa, where organized crime becomes deeply entrenched with political elites. Then there is the political risk. While the Government of National Unity has stabilized sentiment, the ANC's internal dynamics remain a wild card. With a leadership race looming in 2027, The Economist suggests that a shift towards a populist coalition could still be catastrophic. The verdict? The reforms are genuine, but the hole is deep. As The Economist concludes, if South Africa is indeed going to turn the corner, it had better get a move on.
The 8th Annual Biz News Conference, to be held in Hermanus from March 10 to 12, 2026, promises to be a feast of brain food, insights, and ideas. The summit of shifting perspectives, second-level thinking for a sustainable South Africa.
Part of the reason why The Economist and others are excited about our potential is that precious metals are on a rip. The gold price was up $200 on Tuesday night, another $300 an ounce last night.
While the dollar is back negative against its major peers, despite these comments from Scott Bessent yesterday, gold, copper and silver have all hit record highs. How much is that the debasement trade? And are the metals ripe for a nasty come down here?
So, two questions there. One is, I think a chunk of this is definitely the debasement trade. I get a little bit nervous about that term, but it is valid to some extent. People are looking to diversify away from the US dollar. This is not about the end of the US dollar as the world's main reserve currency. It's just about they've been massively overexposed and they're looking to reduce that exposure. Now, there are the other major fiat currencies out there aren't looking particularly attractive. In the mid-2000s, when we went through a phase of trying to diversify away from the dollar, we were getting very excited by the euro, which was kind of fresh and new and looked like it was really uniting well. We were getting excited by the yuan, which had joined the WTO. The Chinese market was booming. Its assets were booming. And we even were much more positive about the yen. We didn't realize it was still in the early stages of 3 decades of stagnation. So I think there were many exciting options back then, and we really got excited about emerging markets. It was the rise of BRIC. Today, people having been burned on these kind of narratives before are not as excited by the counter narratives. So they're like, we can increase exposure to some of these other currencies, but they're not great alternatives, which is why they're piling into real assets. They're basically worried by the fiat currency idea, which is where we got the debasement trade idea. So they're looking for real assets, and precious metals are both a benefit from being a kind of a real asset, but also by that idea that they are haven assets. They benefit from uncertainty, from risk aversion. They've got a historical record of being sometimes stepping in as currencies. So absolutely what's happening in metals is about that. You ask whether they're ripe for a drop. The rallies of the last couple of months have been truly extraordinary, particularly in silver, more so than gold. But you could have said they looked ripe for a collapse at any point since December, and they've got another 30-40% since then. Sorry, more than that, apologies, because I think silver's actually up about 60% year to date. The moves are happening so fast I can't keep track. So I think that they look really overextended, but you know what? The people who have lost money here have been the people trying to pick the tops. I think we're in a frothy end game. That does not mean you start shorting it today.
Hermanus is a man from this windy little town called Yaku. Sorry, other way around. Yaku's from Hermanus. Yaku, we need to talk about your upgrade problem.
I don't have an upgrade problem.
2 Audis, an Opel, a Kia, and a Hyundai. It's 5 cars, Yaku. Denial.
I just love cars. And we buy cars that make it so much easier for you and convenient to sell your car. You want to try it?
Okay, just once. Turn off the cameras. I see how this is addictive. Take 2 of those. WeBuyCars, the easiest way to sell your car by far.
With the pendulum finally swinging in the right direction and international investors poised to end their decades-long strike on investing in South Africa, we can get it right this time, says Peter Major, our mining guru. We should have done it in 2008. This time around, an addressing of legislation will ensure that the taps are opened and mining becomes a source of global investment again, but work is needed.
Capitalism is made for this, Alec. Capitalism is made to fill vacuums. Where there was a vacuum and now there's demand, That's where capitalism comes in. And this is what we saw in the 70s when South Africa was starting mines left and right because the gold price went up and it made a lot of deposits that were marginal. Hey, gold went flat for 40 years. It stayed at $35 an ounce for 40 years. So South Africa was still opening mines, but very selectively. It was the highest grade mines and ones that could justify the return on investment. But when the 70s came, they started reopening older shafts and they started opening a lot of new mines. We're going to start seeing that all over the world now. And it's the juniors that have lagged this. The juniors and the new mines that haven't been exploited, that probably weren't economical at $1,000 or $1,500 gold. They were definitely economical at $2,500 gold, that people were too wary putting money in, thinking, oh, this is a top. But now at $5,000, you're very happy to put money in a mine that gave a great IRR at $2,500. So that's what I see. And I foresee that people are going to say, oh, Goldfields, Harmy, it's discounting too much. But hey, here's some juniors that are close to producing, that have good ore bodies, and they're not reflecting that. We were talking about Orion here before, sitting there at 20 cents for a year and a half, and yet the copper price is going up. Well, all the listed copper companies, they went up to people are saying, maybe they're getting a little pricey. Here's the copper mine just about ready to start. It hasn't moved at all, even though the copper price is up 50, 60%. So that's what capitalism is going to do. And this government should decide, do we want to be capitalist or do we want to stay this pseudo-socialist? Because if we want to be capitalist, we can do like a lot of countries north of us. Say, guys, come in. Here's some real low-grade mines. We will denationalize them. You can have them. You'll own them lock, stock, and barrel. Or we're going to cut the royalty on new mines. There was never a royalty here until the MPRDA came out back in 2004, Alec. And the government made a lot more money before they put a royalty on than when they put this royalty on. I know Trevor thought he was a genius and, we're going to get money from the mines whether they claim a profit or not. Well, you just shut a bunch down that weren't claiming a profit. So there's a lot of things we can do that are going to have to align themselves with capitalism if you want to bring the money in.
Well, it's pretty much a good news program to end our week. Remember, we'll be back again on Monday. And we finish off with the wealth building tip from Pitvillion, who says that South African assets really do deserve a second look, especially by South Africans who've been putting most of their money offshore.
To the extent that valuation determines investment outcomes, which it does to a large extent, I think we can continue to expect this sort of trend happening. As we've been speaking about for a number of years, 2, 3 years, 4 years now, South African assets are fundamentally undervalued, and they are fundamentally underowned by South African investors and by offshore investors. I think emerging market investors are very underweight South Africa, and South African investors have been listening to advisors telling them to take their money offshore as fast as they can, as much as they can. So they also have very little exposure to South African assets. So it's undervalued and underowned. So I think the combination of that with the backdrop of improving fundamentals in terms of lower oil prices, higher precious metals prices, and lower interest rates, I think argues for continued good performance from South African assets. On the other hand, US assets are massively overowned. The US makes up over 70% of the MSCI world, whereas the GDP is probably only about 40%, if that, of the world. So it's massively overrepresented in the index, and investors are overweight the US. So I think it's overowned and overvalued. So you have, on the one hand, overowned, overvalued assets, on the other hand, underowned, undervalued assets. And I think that argues, in the absence of anything else, that the undervalued assets should outperform.
Thanks for joining us. We'll be back again on Monday. Cheerio.